Sure. So yeah, hi everyone. We're the Federal Reserve team. We've been working on this project the last few weeks, as you have with your respective banks. The team is made up of myself, Alex, Tim, and Yunjia. And for the rest of the presentation, I'm going to be handing over to the three of them to go through what we've researched and what we've put together these last few weeks.
So first, I'm going to have a brief introduction about the Federal Reserve, the Board of Governors, and the 12 Federal Reserve banks. So the Federal Reserve is the central bank for the US. It is the financial institution that gives privileged control over the production and distribution of money and credit for a nation of group or a group of nations. It is responsible for the formulation of monetary policy and the regulation of member banks. So the Federal Reserve System contains Board of Governors and 12 Federal Reserve banks. Both come together to discuss and agree policy in the Federal Open Market Committee. So the Board of Governors contains 7 members appointed by the President of the United States and confirmed by the Senate. The governors serve 14-year term to ensure the stability, and President and Vice President are appointed to a 4-year term. There are 12 Federal Reserve banks in the US, each acting as the store of reserves for the commercial banks in that region. We can see the diagram below, and each bank is responsible for the minting of coins and printing of notes in that region and for monitoring local financial conditions. Each is headed by a president who is elected by the representatives of Reserve banks, constituent commercial banks.
The Federal Open Markets Committee is really the committee within the Federal Reserve System that decides on monetary policy. It has 12 members, so all 7 members of the Board of Governors, the President of the New York Federal Reserve Bank, and 4 of the remaining 11 Federal Reserve Bank presidents, and they're rotated on a 1-year terms. The reason that the New York Fed has such kind of a special position is because all open market operations, something I'll explain in a minute, are conducted over the trading board there, and it's kind of viewed as first among equals among the reserve banks. The Federal Open Markets Committee decides on the target federal funds rate and directs open market operations to achieve this target federal funds rate. They meet 8 times per year by law, but sometimes more in times of crisis, like in March 2020, they met twice to address the forthcoming coronavirus crisis. The meetings are private, but the discussions and results are outlined in the minutes reports. They present and discuss various reports on economic, financial decisions, debate them, and they normally agree on a consensus, which is held to a vote, the policy decisions, and they generally tend to be heavily skewed one way or unanimous. There have been, I think, fewer than 500 disagreements since its inception in 1935. Then twice per year, the chairperson, currently Jerome Powell, appears before Congress to outline the monetary policy objectives and plans of the Federal Open Markets Committee going forwards.
So the Federal Reserve follows a dual mandate, which means that it follows 2 objectives, basically. So the first one is to stabilize prices, and the second one is to maximize employment. Note that these objectives can be contradictory at times, so it gives the Federal Reserve a bit of leeway over which to prioritize over the other. So for example, like Chairman Paul Volcker, during his chairmanship, the Fed prioritized price stability over unemployment, which saw like interest rates being as high as 20%, with unemployment being high as well, but at a benefit of there being low inflation. More recently, Chairman Powell, under his chairmanship, the Fed seems to have prioritized, gone more the other way, so that there's like more inflation, but also less unemployment. The Federal Reserve is also independent. So its operational independence is enshrined by the fact that although the US government can appoint board members to the board and also to the FOMC, they cannot be removed until their term has ended. So yeah, and that 12-year terms, I believe, it goes through multiple like terms that a politician will serve. So yeah, so no individual politician would be able to like influence it too much. Yeah, the Fed's independent because politicians tend to prefer maximum employment in the short run, you know, for like elections, like electoral reasons, basically. And that is not necessarily conducive to stability in the long run.
The interbank lending market is where banks borrow and lend money to one another overnight to meet liquidity and reserve requirements. And the interest rate at which these transactions occur is called the federal funds rate. And up to 2008, the federal funds rate existed in something called the corridor system, which is set essentially by a ceiling at the lending rate, which is the discount rate offered by the Federal Reserve, and a floor of the deposit rate, which is the interest on balances offered at the Federal Reserve. What this really means is that given banks are indifferent between credit in the interbank lending market and the Federal Reserve deposits, they're never going to take loans at a higher rate than that offered by the Fed, and they're not ever going to offer loans at a lower interest rate than they can get leaving their deposits at the Fed. And up to 2008, we saw the FOMC basically set a target federal funds rate and conduct open market operations, which is the buying and selling of securities in the open market to adjust the supply of money such that they could influence the federal funds rate. And so an example of this, if the Fed sells a T-bill, then what it's essentially doing is taking money out of the system and reducing the supply of money such that the federal funds rate will change, as illustrated on the graph there. And likewise, when the Fed buys a T-bill, is introducing money into the system, expanding the supply, hence the kind of charges of the Federal Reserve printing money over the years. And again, that influences the federal funds rate, which then has implications for interest rates offered to consumers and businesses in the economy, which impacts growth and inflation, and therefore the Federal Reserve's objectives.
So whereas like in conventional monetary policy before 2008, the Fed would stick to like treasury bills only, so at like the short-term end of the yield curve, quantitative easing went further beyond that, so towards longer dated securities such as treasuries and mortgages. It would involve purchasing these securities in order to reduce their interest rate and to keep credit markets liquid. So in theory, the hope is that QE should help stimulate the economy through four effects: portfolio rebalancing, so lower interest rates in the risk-free government debt market would shift investors and banks to lend to like riskier investments, such as like to businesses. There's like a lending effect, so lower long-term rates encourages households and businesses to borrow more, which stimulates the economy. There's wealth effects, so lower interest rates increase asset price valuations, which makes households feel more wealthy and encourages them to spend more of their income. And then finally, there's the exchange rate channel, which lowers, so the lesser interest rate offered by domestic securities encourages funds to move abroad and thereby lowering the exchange rate. So to date, the Fed has conducted $8.5 trillion in asset purchases, mostly involved in QE. So that's $5.5 trillion in treasuries, and that's $3 trillion in mortgage-backed securities.
As a result of this substantial quantitative easing since the global financial crisis in 2008, we've seen a massive expansion of the money supply in the US, as you can see in the two graphs at the bottom here from the St. Louis Federal Reserve. And as a result of this, depository institutions' reserves have increased massively as well. And this means that depository institutions, banks, can quite comfortably meet reserve requirements, and they don't really need to worry about borrowing money in the interbank lending market. And we see this in the graph as having such a high money supply that the intersection with the demand curve is simply at the deposit rate, which means that the federal funds rate moves 1-to-1 with the discount rate and the traditional open market operations and federal open market committees' influence on the federal funds rate does not play the same role anymore. As a result of this, the Fed's had to look to alternative policy instruments, such as forward guidance. No arbitrage means that the return on a 2-year bond is the same as the returns on 2 one-year bonds. And as a result of this, banks base their long-term interest rates on short-term interest rate expectations. And through this, the Federal Reserve uses forward guidance to basically set future interest rate expectations and therefore influence the long-term interest rate, which again has the benefits of offering cheap loans to consumers and businesses to control inflation and maximize output. We can see kind of the mathematical derivation of this there, and on the graph with a lower expected interest rate, we can see that the quantity of long-term investment increases. Now, note that this does really most effectively work over the kind of 1 to 2 year period, and it ultimately does rely on the central bank's credibility. If people believe the central bank, then rates will fall more than if they don't.
So I'm going to talk about the other 2 tools used. The first is international tool and the other is credit facilities. So due to the importance of US dollars internationally, the Federal Reserve has the responsibility of overseeing overseas dollar markets in time of crisis. So one way of doing this is by using the swap lines. So what are swap lines? Swap lines are agreements between central banks to exchange their country's currencies with one another. And it also enables a plenty of currency during stress periods, which are periods that a certain kind of currency has like limited supply in the country. So that under this situation, those banks just go to the central bank, and then the central bank can use swap lines to get a foreign currency from another central bank and then to give it out to the market. So banks use swap lines for overnight and short-term lending only. During the transaction, banks use the same exchange rate as the first transaction. Hence, there's no market risk involved. And for credit facilities, during economic shock, there's a higher cost involved for those private banks, for those companies to borrow in the private lending market, as those private banks become more risk averse. So they're gonna to increase the interest rate. So under this situation, the government can actually use the credit facilities, which is individual one-off policies which supports the flow of credit to employers, consumers, and businesses. And in March 2020, the Fed introduced an individual credit facility for the money market funds, auto and student loan lenders, municipal governments, and corporate borrowers. So the advantage of using credit facilities is to mitigate the effects of market volatility.
With regards to actually setting the nominal short-term interest rate and deciding what that is, the Fed utilizes a number of monetary policy rules, and kind of the first significant policy rule was the Taylor Rule, which was developed by John B. Taylor, gentleman top right corner, in his December 1993 paper, Discretion versus Monetary Policy in Practice. We can see it here on the slide where pi denotes inflation and R star T is the equilibrium interest rate, then Y is obviously growth. And when we kind of look at that, we basically see that the nominal short-term interest rate depends on the inflation gap and the growth gap. Now, the intuition of this is that if we have high inflation, then we're going to raise the short-term interest rate. And if we have poor growth, which would mean either a smaller growth gap or a negative growth gap even, then the nominal short-term interest rate is going to fall, which is in line with kind of the intuitive policy making that we've seen over years in monetary policy. Then when we look at this equation and we substitute in that the the Taylor's 1993 assumption that the real equilibrium interest rate is 2%, and we do a bit of rearrangement, we see that the coefficient of pi t, we see that the coefficient of pi t is greater than 1. And what this means is that the nominal short-term interest rate moves more than 1-to-1 with inflation. Note also that this is going to be true for any a pi is greater than 0, which is also something that Taylor posited in his 1993 paper. And the intuition of this is that by responding to inflation in a decisive way, the Fed can control animal spirits and thus inflation expectations, and sets an expectation that inflation will not last, which generates a more effective response to preventing excessive inflation.
So as I mentioned earlier, there's often a trade-off between inflation and unemployment. So central banks often have to choose one over the other in deciding their policy decisions. To do this, they use loss functions, which is basically a mathematical representation of the central bank's preferences for one over the other. So like deviations from their inflation target to deviations from their unemployment target. So I've given an example here of a loss function, and it's quite clear, but the lambda is basically the ratio of the cost of deviations from the unemployment target to the cost of deviations from the inflation target. So if lambda is greater than 1, their preferences would be skewed towards minimizing deviation from their unemployment target. And if lambda is less than 1, their policy decisions would be skewed towards minimizing deviations from their inflation target.
Yeah, sorry. Yeah, so that's the end of our presentation, everyone. Thank you very much for listening, and feel free to ask any questions if you've got any.
Thank you so much for the presentation. If anyone has any questions, you can raise your hand. There's one in the chat, which I'll ask you to ask any questions you want. So the first question is from Suryansh. It says, how frequently does the FOMC revise the Fed funds rate?
Do you guys want to take that, or do you want me to?
I'm happy to talk about that a bit.
So,
well, so at each of the 8 annual meetings, the FOMC reviews the target federal funds rate and evaluates kind of the development of these economic and financial forecasts and analyses since the previous meeting. So at each meeting, there is a reevaluation of the federal funds target rate. But as we see by the fact that it's especially recently quite stable, it's not changed anywhere near as frequently as there are meetings.
nice. Mason, do you want to ask your question?
Yeah, hi. I saw on the Taylor rule slides there was a couple, that one. There's a couple graphs there at the bottom. Can you just go over what they're showing?
Alex, do you want to take that one again? I know you.
Yeah, sure. So these are actually taken from discretion versus monetary policy rules in practice, and they just kind of show how you can go about evaluating the policy rule and understanding the variables that go into it. So the graph on the left just shows how Taylor kind of estimates the growth target. So Y bar T is the kind of potential growth output or growth target. And this is just literally a simple line of best fit on the data between about 1984 and about 1992, which gave a 2.2% growth target, which is, well, certainly at the time was realistic. Now, potentially it is slightly lower over the past 10 years, but it kind of just gives insight into how you would go about actually projecting realistic values for your potential growth output. And then the other graph just shows the nominal interest rate given by the Taylor rule compared to the federal funds rate from 1987-ish to 1992-ish. And it just shows really quite quite an accurate prediction of what it should be and how kind of these intuitive results can be quantified, which is obviously very promising for future monetary policy decisions based on the Taylor rule.
Thank you, Alex. Has anyone else got any other questions? No? Okay, I think, Roberto, we're happy to hand over back to you now. Thank you, everyone, for listening.
Perfect. Thank you so much. Now I have the pleasure to listen to the presentation of the European Central Banking team, European Central Bank team. So I pass over to Ciaran and his team.
Hello, everyone. I have to start by saying I'm really sorry for my late arrival and for missing some of the presentations. I was getting my Wi-Fi to work. I was just about to get in, so not an excuse. So very sorry to have done that. So yeah, this team is going to be, my team is Herder, Michelle, and Annie. The guys have been working extremely hard on this, and we're going to be tackling not just presentations on the ECB, but also some of the tools it uses and some recent developments in the bank itself, particularly the use of tools such as forward expectations and various Taylor and other policy rules to use. I think guys have done some fantastic work, and I'm really looking forward to being able to show the presentation. So I'll hand over to my team now, and I'll get going there.
Okay, I'll share screen. Just a sec. Yeah. Michelle, you can start.
Okay. Okay, so hi everyone, I'm Michelle, and together with the rest of the ECB team, we'll be presenting on an introduction to the European Central Bank. Next slide, please. Yep, so just an outline of our presentation today. I'll be starting off by introducing the ECB and the EMU, as well as some recent revisions to the ECB's monetary strategy. I'll also be going through, then Parada will be going through the monetary policy rules, and Annie will be going through the monetary policy tools. All right, so an introduction to the ECB. So a central bank is by definition an institution that manages the currency and monetary policy of a monetary union. And the ECB is essentially the central bank of the European Monetary Union. The ECB is responsible for conducting monetary policy and maintaining price stability within the European Monetary Union. And it was created first in 1999 when 11 national central banks transferred their responsibility for monetary policy to the Frankfurt-based bank. Since then, another 8 banks have done the same thing, which has brought the total number of members in the EMU up to 19 countries. The EMU is a monetary union consisting of 19 member states, which is collectively known as the Eurozone. And what a monetary union means is that the member countries share a common currency, a common monetary policy, and coordinate their economic and fiscal policy by making limits on government debt and deficits. The common currency is the euro and is issued by the national central banks and the ECB on a joint basis. Next slide, please. Yep, so going on to the ECB's mandate. It is underscored in the Treaty on the Functioning of the EU and the Treaty of the EU. And the main statutory objective of the ECB is to maintain price stability in the Eurozone. This was determined by the European leaders following the Treaty of Amsterdam and reflects the popularity of monetary inflation-wary policies at the time. Once this objective is fulfilled, the ECB has some freedom in deciding how to pursue other economic goals. These include achieving balanced economic growth, financial stability, and full employment. Next slide, please. Yep, so the ECB's monetary policy strategy has seen some recent revisions. In particular, in July 2021, the Governing Council of the ECB met to revise its monetary policy strategy, which is the first time that it has done so since 2003. It took place in the context of increasing concern about the erosion of policy space because of the historically low interest rates and falling inflation expectations globally. This was especially concerning to the ECB because interest rates have traditionally been their main monetary policy tool. At the aforementioned meeting, the ECB reviewed its policy frameworks and adopted an explicit inflation target of 2% to be measured by the harmonized index of consumer prices as opposed to the more traditional CPI. This marks a shift to adopt metrics that would incentivize a more dovish monetary policy. And in addition, the ECB also replaced the goal of keeping inflation below 2%, which was originally established at the launch of the euro. Again, the aim of this is to use a more dovish monetary policy to break free of the low growth, low inflation trap that the Eurozone has been trapped in since the financial crisis. Claudia.
Thank you. So the structure of the European Central Bank is broken down between the Governing Council, the Executive Board, the General Council, and the Supervisory Board. Now, it's the Governing Council which is responsible for monetary policy decisions, and they meet on a bi-weekly basis to formulate policy. Now, the Governing Council consists of the Executive Board, which includes the President of the ECB, which is, of course, Christine Lagarde, and it also includes the governors of every national central bank of all the Eurozone member states. Next slide, please. Now, there's plenty of tools. For the Governing Council to use, torn between the more conventional tools and the more unconventional tools. So first off are the free interest rates set by the ECB, which are the more conventional tools used. So firstly is the main refinancing operations, or MROs. Now, this is the interest rate paid by banks to borrow from the ECB for 1 week. Now, alongside the other interest rates set by the ECB, it aims to ensure that there's sufficient liquidity in the financial system and steers short-term interest rates, and it's currently set at 0%. So the second interest rate set by the ECB is the marginal lending facility rate, or the MLFR. Now, this is the interest rate paid by banks to borrow overnight from the ECB. Notice the difference just in the term between the MROs and the MLFR. It's also a standing facility, which is a financial instrument available to banks to use if they want to use it. Now, the other standing facility is the deposit facility rate, or the DFR. Now, this is the interest rate received by banks when depositing money overnight with the ECB. Now, together, the DFR has been negative since 2014. Now, you may be wondering at this point, well, these standing facilities, if the banks want to use them, what if they don't? If they have excesses or deficiencies in the amount of cash they're holding in the very short term, they can either go to the ECB through the standing facilities, or they can go to the overnight interbank market. Now, what the MLFR and the DFR do is they set an upper and lower limit to the interest rate range in this market. So, for example, if the interest rate to borrow in these markets exceeded the MLFR, banks would have no incentive to go to the market, and they would instead go to the ECB and use their MLFR, and hence it sets an upper limit. Now, analogously, if the interest rate to borrow from the market was below the DFR, the banks would just choose the DFR. Next slide, please. Now, onto the more unconventional tools used. First of all is the long-term refinancing operations, or LTROs. Now, these are loans to banks for a term of 3 months. Now, these differ from the tools we've already discussed, because those had an interest rate determined by the ECB, but here the interest rate is determined by the market. Now, LTROs are used to ease credit conditions in the private sector in order to stimulate real lending and to stimulate then growth. Quantitative easing is the next tool, and it was introduced in the previous introduction, by the Fed. And so it's, of course, just the ECB creating money to buy long-term bonds from banks to lower the yields on these bonds. And by lowering borrowing costs, it helps to translate these borrowing costs across the economy to stimulate growth. Now, it was first officially used by the ECB in 2015, And was more recently seen during the pandemic with the pandemic emergency purchase program, which was 60 billion euros every month by the ECB. Now, of course, it's a very controversial tool because by lowering the yields on the bonds, it raises asset prices, and the assets are disproportionately owned by the wealthiest members of society. And so the wealthiest are disproportionately benefiting from the ECB introducing policies such as QE. Another tool used is forward guidance, which is a verbal assurance by the ECB on the likely path of future interest rate decisions. Now, this is a very important tool because it alters investors' perceptions of future interest rates and inflation, and hence changes investor confidence. And it was most famously used by Mario Draghi in 2014 with his "whatever it takes" speech. Whatever it takes to save the euro. And what he meant by this was he promised to contain the borrowing costs of the southern economies of the Eurozone, and thus arguably saved the Eurozone from breaking apart. Now, the final tool discussed today is minimum reserve requirements. Now, banks across the Eurozone are forced to hold a certain amount of reserves in their current accounts at the National Central Bank. Now, this is determined by the size of the balance sheet and is benchmarked across 6 weeks. So within those 6 weeks, the banks can choose to take out some of the reserves and maybe lend it out to the interbank market, and thus stabilizes the interbank interest rate as credit conditions change. Now that we've discussed the tools, we'll move on to rules with Annie.
Okay, thank you. So wait a sec. Yeah. There we go. So I'll be talking about the monetary policy rules. So these rules govern the way the ECB makes decisions on monetary policies. So we'll first look at the Taylor Rule, which is proposed by John Taylor in 1993. And this is a financial tool central banks use to set their policy instruments in response to changes in inflation output. So as you can see in the equation here, let's say if inflation deviates from the objective inflation, or if output deviates, interest rates will have to adjust accordingly, as the equation is shown here. And intuitively, this is aimed towards reducing inflation by reducing aggregate demands and through other transmission mechanisms. So, however, evidence has shown that standard Taylor Rule explained here, it consistently overestimates the ECB interest rates. So there are other alternative policy rules that the ECB considers when setting monetary policy. So we'll now take a look at some of the alternative policy rules. So firstly, we look at interest rate smoothing. So this accounts for the extent by which the current policy rate is determined by past policy rates. So in normal cases, this is closer to reality because central banks smooth interest rates very gradually, and the ECB is especially known for this. So according to Belk and Close in their paper in 2019, as an example, they suggested that high interest rate smoothing term of 0.97. This means that the 97% of the current policy rate is determined by the past policy rate, and that only 3% is influenced by the standard Taylor Rule. So another extension is the forward-looking Taylor Rule. So as shown here, so this basically replaces inflation rate by the expected inflation. So in the ECB case, this is measured by the data is taken by the ECB survey of professional forecasters. So this is because central banks sometimes respond to a bit too late due to the lag response. A forward-looking Taylor Rule should be proposed. And another alternative is the alternate days rule. So this is similar to the Taylor Rule to a large extent. So the main difference as shown here is that the target inflation is allowed to vary, whereas the Taylor Rule target inflation is set at 2%. So we'll now look at a graph that compares the two monetary policy rules. So in this case, the opening days rule and the standard Taylor rule with the ECB interest rate, in this case, measured by the Euro overnight index average. So we can see that the opening days rule shows fewer deviations compared to the standard Taylor rule. Therefore, it provides a better fit in this case. However, just something to note in the end is that there are also other alternatives that the ECB could be using. So not just alternative rules, but also studies have suggested that the ECB could be using a combination of different policy rules. So we still don't really know which rule best determines the ECB monetary policy, and it is definitely not a straightforward question to answer, and more research has to be done on this. So yeah, that is the end of our presentation. So any questions?
I think there's a question in the chat, and thank you so much for the presentation. It says, it's from Alex, and it says, why do banks take long-term refinancing operations instead of loans in the market if they are offered at the same rate?
I can take that if you guys want. So basically, first of all, thanks for the question, Alex. Long-term refinancing loans are basically terms, it's an instrument used by central banks in order to be able to offer banks liquidity when there isn't many alternatives in the market. So for example, during times of financial uncertainty, banks would, even though they might offer loans at similar rates, they would often prefer not to lend because they tend to be much more conservative in times of, say, financial crises or economic downturns. So at this time, it becomes the position of the central bank to offer long-term refinancing loans to ensure the continual flow of the financial system until conditions improve. So that's essentially, it's a tool used by central banks to ensure that, and that's what, and in a way that markets can't.
Any other questions?
I've got another one actually.
Oh.
Thank you for a great presentation, firstly. I think this is for Annie, who did the stuff on the Taylor rules. I saw that the coefficient for the inflation gap in the Taylor rule you used was 1.5. And I've read some stuff around that, and I was just wondering why in your Taylor rule, so in mine, obviously, it was 0.5. And I was just wondering what explains the difference between the two in your view.
Sorry, it took a while for me to unmute myself. Obviously the coefficient measures. So for example, if the coefficient in front of the inflation deviation is 1.5, that means that for the change in every unit, so in regression terms, it means for the every change in unit in inflation deviations, the interest rate needs to increase by 1.5 times that change. So personally, I took that. From the standard Taylor rule that John Taylor proposed. So obviously, this coefficient can vary, as you suggest. It is a different term for the Federal Reserve. Therefore, I think this depends on the situation of the central bank. So yeah.
I think I have to point out that it might also be due to the specifications of the models. Because if you add the inflation term at first, you should multiply that by 1 plus the coefficient you got. So I think that's what explains the differences. That's why one has 1.5 and the other one has 0.5, because one includes the inflation term and the other one doesn't. But please correct me if I'm wrong.
Yeah.
Is there any other question?
Yeah.
If not, I think we can proceed to the last presentation of the day. Thank you so much for the European Central Bank team. And please, Mason and Steve, they can proceed to share the slides.
Thank you. Yeah, hi guys. Myself, Sean, Sana, and Andy have been working on the Bank of England presentation. Yeah, the three of them been working really hard, and yeah, I'm going to hand over to them to take over.
So I'll just start with what is a central bank? Basically, they're institutions that manage a country's currency and monetary policy, and they have the power to make changes to the money supply and regulate commercial banks in the economy. And they tend to be nominally independent of the country's party politics. Next slide, please. So on this structure, the Bank of England is structured in the following way. It has a governor who oversees its operation and higher level decision making. The court of directors are responsible for overall strategy and budget. The Prudential Regulation Authority regulates financial services and markets. The Financial Policy Committee maintains stability in the country's in England's financial system by identifying and mitigating systemic risks. And the Monetary Policy Committee is in charge of the bank rate and other monetary policy initiatives. And they will be discussed further in the next slide.
So the MPC's role is to make decisions about the bank rate, implement monetary policy and set interest rates. And they also direct the quantitative easing and forward guidance areas of the country's monetary policy framework with the aim of keeping inflation low and stable. And another role is to support the government's broader economic policies in order to achieve economic growth and employment targets. So the MPC is made up of 9 members. So the governor, 3 deputy governors for monetary policy, financial stability, and markets and banking, the chief economist, and 4 external members appointed directly by the Chancellor. So currently the members of the MPC for the Bank of England are Andrew Bailey, Ben Broadbent, Sir John Cunliffe, Jonathan Haskell, Catherine Mann, Hugh Phil, Sir Dave Ramsden, Michael Saunders, and Silvana Tenrero. So the MPC meets 8 times a year to set and announce policies, and each time they meet there are 4 meetings. So in the first meeting, the Bank of England staff present the latest economic data and analysis, and then in the second meeting the MPC members look at what has changed in the economy since the last meeting and its implications on economic growth and inflation. And then in the third meeting, every member gives their assessment of these recent economic developments and says what monetary policy they think should be implemented by the Bank of England. And in the final meeting, the governor states what monetary policy action is likely to be supported the most by its members. Then all the members vote, and anyone who disagrees with the majority view states their alternative approach that they would support, and then their decisions are published.
So as mentioned by Sana earlier, QE and forward guidance are 2 of the monetary policy tools that are used by the Bank of England. And in this section, I'll be giving an overview of the 2 policy tools. So I'll start with QE, quantitative easing. So basically, QE is a form of unconventional monetary policy, which is used to inject money into the economy by purchasing assets, financial assets, theoretically like most securities, but in practice, mainly government bonds. And we see that the aim of QE is to keep interest rates low and to stimulate economic growth. So how has the Bank of England implemented QE? We see that the BOE has implemented QE in the aftermath of the 2008 financial crisis. And to date, the bank has bought about £895 billion worth of bonds through QE. And as you can see from this pie chart over here, it's mostly dominated by UK government bonds, which is worth about £875 billion, and the remainder being like £20 billion worth of corporate bonds. On this slide here, we have a very, very simplified model, basically showing the main mechanism of how QE is meant to stimulate the economy. Basically, the Bank of England buys government bonds of longer maturity. And this is basically what gilt purchases mean. Yeah, so when you buy government bonds, this decreases the quantity of bonds and it increases demand for bonds and decreases the quantity of longer maturity bonds. So this raises the prices of the bonds and lowers their yields. And as an aside, a side note, this actually affects the yield curve, and you can see that the yield curve generally is like kind of lowered and somewhat flattened. And back to the topic, basically in this diagram, we see that there's two main mechanisms. I think it's explained quite well by the previous two groups, but I'll just talk about it again. The first one is basically it decreases the yields on the bonds. Oh, actually, never mind. I'll talk about the bottom one first. The purchase of the bonds basically increases the price of the bonds. So this increases the wealth of the bondholders via capital gains. And this is meant to stimulate like household consumption. And the second way this QE works is through the decrease on the yields of the bonds. So because the price of the bonds goes up, the yields go down. And when the yields go down, it's cheaper for companies to borrow. So this is meant to stimulate investment. So overall, we see that by encouraging companies to invest and by encouraging households to consume, this is meant to stimulate domestic demand and hence GDP growth. So has it been effective in the context of the UK? At first glance, it does seem to be kind of effective. So I read a paper by Joyce 2012. So he analyzed the financial data and macroeconomic trends in the period, and he mentioned that a cursory glance would suggest that yeah, it does seem to be effective because the timing of QE coincided with a rally in asset prices and a fall in bond yields in the UK, which is what it's meant to do. But of course, there are some caveats to this view. He mentioned as well that at the same time that QE was implemented, the fiscal authorities also implemented fiscal policies to stimulate demand. So this could be another contributory factor that could account for the changes. The second thing is also that it's pretty difficult to quantify the macroeconomic effects of QE for two reasons. The first is that there's some sort of policy lag between the implementation of QE and the effects. And the second is that because it's a form of unconventional monetary policy, there's a lack of historical precedent compared to, say, conventional monetary policy and normal fiscal policy. The third thing, actually mentioned pretty well by the ECB team, it increases inequality. So as mentioned by them earlier, as mentioned earlier by me as well, basically the asset prices go up. And because the wealthy disproportionately hold the wealthy hold a disproportionate amount of assets, so they benefit most from this increase in capital, increase in asset prices. So this increases inequality, which decreases welfare. And the final point is that it may be potentially inflationary, and this was highlighted by a report by the Economic Affairs Committee for the House of Lords. So basically, it's in light of the growing economy, substantial government spending, and a recovery in demand after the COVID-19 pandemic. So moving on to forward guidance. Next slide, please. Yeah, forward guidance. So what forward guidance is the central bank announces future short-term interest rate plans. And the purpose of this is to anchor the private sector expectation of the future path of monetary policy. And this is pretty important for like companies to make investment decisions or for consumers to make consumption decisions. And through arbitrage, this also affects this basically affects the expected returns on bonds, and it also affects the long-term yields to date. Next slide. Over here, we have an example of how the BOE has implemented forward guidance. So this is an excerpt from the MPC September 2020 minutes. So it basically stated their short-term plans. And what we can see here is that it anchored the market expectations of what the bank rate will be. So in this case, it was the bank rate was expected to remain low. So you can see how it we could see how it's in play. Next slide. As for whether it's effective, the literature is pretty mixed about it. I would say, yeah, it's pretty debatable. Some authors agree that, yeah, it's pretty effective, but there are others who disagree that is who feel that it's not a very effective monetary policy tools because they don't actually have much effects on current output and employment.
So loss functions are another tool that is commonly used by central banks. And to start with some context, a central bank has preferences with which it makes decisions on the bank rate and other monetary policy tools. And they primarily want to minimize any deviation from their targets for inflation and output in the economy. And these preferences are presented in the loss function. So as an example, if there's more loss calculated, the central bank wouldn't be sufficiently close to its inflation or output targets. And if a country's central bank was more concerned with employment than inflation, it would tolerate more deviation from its inflation target compared to its output target. And due to the nature of the function and it being a sum of these two components of inflation and output, this can be easily measured.
So another rule that's used is the Taylor rule, which is an interest rate forecasting model that suggests how central banks should change their short-term interest rates depending on the rate of inflation relative to its target and the level of output relative to its trend. It also acts as a guide to gauge the proper level of money supply. And according to the Taylor rule, interest rates should be increased when inflation is above target or economic growth is greater than the long-term trend growth, and lowered if the conditions are the opposite. So the Taylor rule formula is as displayed on the slide, where I is the nominal interest rates, P is the annual inflation rate, P star is the target inflation rate, R star is the equilibrium real interest rate, Y minus Y star over Y star is the output gap, and W1 and W2 are the weights given to the deviation of output and inflation from their respective trend and target. Next slide, please. Okay, so the Taylor rule complements other variables that the Bank of England uses. So it's often thought that the rule is good as an approximation given the small number of variables it uses. And defenders of the rule argue that it's only meant to be used as a guideline, so other variables other than inflation and output should also be considered by policymakers. However, Svensson argues that the Taylor rule is incomplete and too vague to be operational, and also that the Taylor rule does not allow policymakers to react to changes in the transmission mechanism or shocks in the economy. Next slide, please. So an instance where the Taylor rule worked was during the UK's membership of the European exchange rate mechanism, where the Taylor rule followed the actual interest rates closely, as we can see in figure 3. And in 1993, Taylor used the values of 1.5 and 0.5 for the weights of the deviations. And in 2000, Nelson used quarterly data from Q4 in 1992 to Q1 in 1997 to estimate the Taylor rule, finding that the long run estimated coefficients of inflation and the output gap were 1.27 and 0.47, which were very close to Taylor's combination. And during the financial crisis in 2007 and 8, it was also thought by some that the central bank's decision to keep interest rates low following the dot-com bubble resulted in the housing bubble, which led to the housing crisis. So had the interest rates been higher in accordance with the Taylor rule, less people would have been incentivized to take out the mortgages and the housing bubble would have been smaller. Thank you.
Thank you so much for this great presentation. There are 2 questions in the chat. The first one is from Sharon. He wants to compliment you on the presentation, but he also asks, can you explain the Bank of England's reasoning behind the recent decision not to raise rates in contrast to the US Fed? Quite ambitious question, not gonna lie.
Yeah, well, I know a bit about it, but I'm not too sure it is correct. But from what I understand, I think it's because there's some uncertainty in the labor market. From what I've read, it's because of the end of the furlough scheme in the UK. I think it ended in end September or something. So, and they saw that there's like quite a lot of there's a higher than expected number of like jobs that were furloughed after the scheme ended. So there's some uncertainty in the labor market, and that's why they decided to hold off like the change in interest rates compared to what the Fed did. And to respond to Alex's question, my personal opinion is that I think it kind of neglected forward guidance, because as mentioned by Alex, there's a lot of expectations that the BOE will raise the rates. So I think that it does undermine the use of forward guidance as a policy tool, because as mentioned by one of the earlier groups earlier, forward guidance, the effectiveness of forward guidance is also somewhat linked to the credibility of the institution. So if this sort of stuff happens, then certainly that it'll be less effective in the future. Yeah. Would anyone else like to add on?
Yeah, adding on that, remember the next part of this program, of the distribution program, we'll tackle actually the last rates decisions, the last monetary policy committee decisions. So I think you have an excellent chance to actually analyze why the UK central bank, which is the Bank of England, decided to keep rates as they are rather than follow suit as the US Fed was doing. I think there's another question. I don't know if it was already answered. It says, to that point, do you think that the recent BOE decision neglected forward guidance at all? I know that there was a lot of speculation around the BOE raising rates, and Governor Bailey has been criticizing for not managing these expectations.
Yeah, I think Andy covered that just then, but yeah, essentially it's kind of defeated the point of forward guidance when you can't trust the central bank. If they say that interest rates are going to rise in the future and then keep them low, then that just affects all the arbitrage conditions. But yeah, Andy pretty much covered it.
Perfect. Is there any other final question? Well, since not, I want to thank all the teams for taking the time to prepare this excellent presentation. Thank you for the guests. I saw some people who are not from the division who joined in to hear these presentations. Thank you too. And I'll see you later for the brief on the second activity, and later on our presentation for the second part of this special program. Thank you for coming and have a good day. I will stop the recording.